Welcome to this review session. Today, I'm going to be your professor as we master the complete life cycle of share capital accounting. Whether you're gearing up for a massive exam or you just want a rock-solid grasp of corporate finance principles, well, you're in exactly the right place. We're treating this explainer like a definitive masterclass. We're going to break down exactly how a company goes from a simple idea to raising millions, and exactly how we account for every single rupee along the way. So grab your notebooks and let's dive right in. Here's our syllabus for today's crash course. We'll hit the core concepts of shares, the public issue process, subscription types and pricing, calls, forfeiture and reissue, alternatives to public cash, and finally, the share capital balance sheet. All right, part one, core concepts of shares, the absolute foundation of corporate finance. Think about it. When a company needs massive capital, like way more than a bank is ever going to lend them, it divides its total required capital into small, equal units. These are your shares. A share is exactly what it sounds like. It's a literal piece or share of ownership in a company's total pool of raised money. And if you buy one of these units, you become a shareholder, meaning you're legally a part owner of that entire corporation. How cool is that? Now, you're going to want to pay attention here because this is a highly testable distinction. You've got equity shares and preference shares. Equity shares are your ordinary shares. These shareholders are the true risk takers. They get the voting rights, but their dividends, those are paid absolutely last. It's high risk, but potentially high reward. On the flip side, preference shares are, well, exactly what they sound like. They get preference. They're paid a fixed dividend first, which makes them lower risk, but the trade-off is they generally have to surrender their voting rights. Moving on to part two, the public issue process, or asking the public for money. So, this whole process kicks off with an absolutely crucial document called the prospectus. And listen, this isn't just some glossy marketing brochure. It's an official, highly detailed invitation literally asking the public to buy shares. It has to be strictly approved by SEBI, the regulatory body. Why? Because it contains everything an investor needs to make an informed decision. We're talking past financials, future plans, the specific number of shares offered, the price, and most importantly, every single risk factor involved. Now, rather than just picking a share price out of thin air, modern companies use a clever process called book building. They set a price band, say between 100 and 120 rupees, and investors bid on what they're willing to pay. The final price is discovered based on actual market demand, and this operates right alongside ASBA, or Applications Supported by Blocked Amount. It's a brilliant investor-friendly system where your money stays safely in your own bank account, still generating interest, and it's only officially debited if you actually win the shares. But here is a massive hurdle you need to remember. 90%. Under the Companies Act 2013, there's a really strict rule regarding minimum subscription. If a company goes to the public but fails to get applications for at least 90% of the total shares they offered within 30 days, the entire issue fails. Gone. The company has to cancel the offering and refund every single penny back to the public. It's basically a built-in safety net to make sure a company doesn't start a huge project wildly underfunded. Okay, part three, subscription types and pricing. Let's look at how the market actually responds. Historically, there are three ways to price a share. At par is the easiest. A share with a face value of 10 rupees is sold for exactly 10 rupees. Simple, right? Then you have at premium, which means selling a highly demanded share above its face value. So, say 15 rupees for a 10 rupee share. That extra 5 rupees is crucial for accountants. It doesn't go into regular share capital, it goes into a special account called the Securities Premium Reserve. Finally, we have at discount, which is issuing below face value. But note carefully, issuing shares at a discount is essentially banned today under the Companies Act 2013, with very, very few exceptions. So what happens when demand doesn't perfectly match supply? You get one of two scenarios. Undersubscription is easy. As long as it's above that 90% minimum we just talked about, the company simply gives everyone exactly what they asked for. But oversubscription, that's when the public applies for way more shares than the company actually offered. And that creates quite the logistical problem. Let's test your accounting logic for a second. A company only has 10,000 shares to give out, but the hype is totally real and investors have applied and paid for 20,000 shares. You obviously can't magically create more shares out of thin air. So how on earth do you handle this oversubscription scenario fairly? Well, the solution we use in accounting is called Pro-Rata allotment. It's just a strictly proportional math exercise. If 20,000 shares are applied for, but only 10,000 are available, we calculate the ratio. In this case, that's a 1-to-2 ratio. This means for every 2 shares an investor applied for, they're allotted exactly 1 share. The excess money they sent in is typically kept by the company and adjusted against future calls, or it's just refunded. All right, moving right along to part 4, calls, forfeiture, and reissue. Let's talk about dealing with defaulters. First off, we've got to classify the timing of the payments. Try to memorize this dynamic. If a shareholder is late and misses a payment deadline, that's called calls and arrears. Since the shareholder is basically holding on to company money, the company charges them interest. On the flip side, what if an eager investor pays their future installments early? That's calls in advance. In this situation, the company is holding the investor's money early, so the company actually owes the investor interest. Makes sense, right? But here's the crucial point. What if a shareholder in arrears simply never pays? Well, we enter the default life cycle. Step 1, failure to pay. Step 2, the company gets aggressive and executes forfeiture. This means they formally cancel the shares and, here's the real kicker, they keep whatever money the defaulting shareholder had already paid in the past. The shareholder loses everything. Ouch. Step 3, the company doesn't just throw those canceled shares away. They execute a reissue, effectively selling those forfeited shares to a brand new buyer. Now, when reissuing, there's a golden rule you have to know. Professors absolutely love to test this, so watch out for the trap. We said earlier that issuing new shares at a discount is banned. However, reissuing forfeited shares at a discount is totally legal. But the mathematical rule dictates that the discount given to the new buyer cannot possibly exceed the amount the company confiscated from the original defaulting owner. Basically, the company can't take a total loss. That retained money from the defaulter absorbs the discount given to the new guys. That brings us to part 5, alternatives to public cash or non-standard issuance. You see, sometimes a company prefers to just use its shares like currency. We call this issue for consideration other than cash. For example, let's say a company wants to buy a massive new office building. Instead of going through the hassle of raising cash from the public to pay the seller, they just issue shares directly to the seller of the building. The accounting here is beautifully simple. You just debit the specific asset or service received to increase it on your books, and you credit share capital. Done. There are 2 other vital non-public alternatives we need to cover. First is private placement. This is when a company completely skips the slow, expensive public prospectus process and just issues shares directly to a few select, wealthy institutions or high-net-worth individuals. It's incredibly fast and cheap. Second is ESOPs, or employee stock option plans. Now, this isn't really about raising immediate cash, it's a strategic HR tool. By giving key employees the right to buy company shares at a locked-in, fixed price sometime in the future, the company motivates them to work hard and significantly boosts talent retention. Finally, part 6, the share capital balance sheet. Time to record the journey. I want you to think of these capital categories like Russian nesting dolls. Each layer perfectly fits inside the one above it. At the very top, we have authorized capital. That's the absolute legal ceiling of what the company is allowed to raise. Inside that is issued capital, the portion they actually offered to the public. Inside that is subscribed capital, the amount the public actually applied for. Out of that, we get the called-up capital, which is the installment money the company has explicitly asked for so far. And finally, sitting right at the core, is paid-up capital. This is the actual tangible cash received from shareholders after subtracting any of those calls and arrears we discussed. Paid-up capital is the ultimate number that matters for the balance sheet total. And just before we close the books, remember our earlier rule. Any extra money collected above face value during the issue phase has to be carefully separated. Please do not mix it into the base share capital figures we just reviewed. It gets its very own special home on the balance sheet under the Securities Premium Reserve. Keeping these distinct is a fundamental, non-negotiable accounting principle. So that brings us to our final challenge for you today. If you were handed a blank sheet of paper right now, could you accurately chart the complete journey of a share from the maximum authorized limit all the way down to the final paid-up cash? Take a deep breath, review these core steps and journal entries we've just covered, and you're going to be perfectly prepared to tackle any complex corporate accounting problem that comes your way. Keep revising, keep practicing those entries, and you are absolutely going to ace this topic.